Well, this is simply incredible. I don't even know where to begin. Thank you so much. Thank you, Clemens. Thank you, Wojciech, for that laudation. It is really an honor to be the 2023 Richard Musgrave Distinguished Professor, and to be the first live ceremony that you've had since COVID. It's wonderful. Although I never met Professor Musgrave, he had a profound effect on me. I started college as an engineering major, and then I took my first economics course and said, forget engineering, I'm going to be an economics major. And then I took a public economics course, and I said, I've got to go to graduate school, and I've got to study the economics of taxation. That's a true story. And what was the book that made it all happen? Musgrave and Musgrave, Public Finance in Theory and Practice, 4th edition. I looked it up. As a public finance economist, I've benefited greatly from Richard Musgrave's work. And as an international tax scholar, I've been strongly influenced by Peggy Musgrave's contributions. So in today's talk, what I'm going to do is I'm going to take you back to a time not so long ago that we might call the golden era of tax planning. And my focus will be on tax planning by U.S. multinational corporations. It was a very colorful period that I think many of you remember well. One could say that Europe was the epicenter. So let's get started. So the golden era of tax planning starts in 1997, but let me remind you that at the time, the U.S. had a worldwide tax system. The U.S. taxed both the domestic and the foreign profits of U.S. multinationals with a foreign tax credit for taxes paid abroad to prevent the double taxation of foreign income. No tax was due on foreign profits until that money was repatriated. That's called deferral. So what we had was a credit and a deferral system, credit and deferral system. Now, current tax was imposed on certain tainted income, including passive income and payment of interest, dividends, and royalties across affiliates in different jurisdictions. And this will be important for the story that I'm going to tell. In 1997, everything got kicked off with regulations that the U.S. Treasury promulgated that we call check the box, which made it easy to create hybrid entities. This, as I said, kicked off the golden era. Now, multinationals have affiliates at home and abroad. So a multinational might have an affiliate in Germany that has an affiliate in Ireland or vice versa. They have tiers of ownership. And making some of the affiliates hybrid entities greatly facilitated multinational tax planning. Now, I'm going to provide more details on the check-the-box regulations and on hybrids, but let me give you a quick explanation, because at this point I have to. What is a hybrid entity? So what is a hybrid entity? A hybrid entity is an entity that's a corporation from the host country point of view and a pass-through from the home country point of view, or vice versa. It's the duck rabbit of international tax planning. So lay your eyes on this strange illustration. Is it a duck? Is it a rabbit? Well, the magic of this illusion is that it's both a duck and a rabbit, and that's what makes the image so special, and as we will see, that's what makes tax planning with hybrid foreign entities so effective. I got the idea for the duck rabbit from an article on hybrid tax planning in The Correspondent by a journalist named Jesse Frederick. Now, the duck rabbits that were made possible by the check-the-box regulations led to a remarkable increase in the complexity of the tax planning strategies of multinationals. Leaks and special government reports revealed that multinationals use hybrids to exploit mismatches in tax law across countries and to create stateless income. But what do I mean by stateless income? This was a term that was first coined by Edward Kleinbard, a tax lawyer turned scholar who unfortunately is not with us today. He had a real way with words, and I love this definition of stateless income of his. So he had more technical definitions too, but this definition is income that through tax planning first becomes unmoored from the host country where it's earned, and then sets sail for the tax haven of choice. So it's income that's earned abroad that through tax planning is not taxed where it's earned, but instead it's taxed in another jurisdiction where there's little or no tax at all. And by the way, as we're going to see, those tax havens don't have to be islands with sandy beaches, not at all. So it didn't take long for us to expose golden era tax planning. It didn't take long for it to be exposed. Data were showing that the foreign effective tax rates of multinationals were going down. In the United States, we started talking about how multinationals could use self-help to lower foreign tax burdens. That's a great term. We suspected that check the box was playing a role in lowering foreign effective tax rates. And governments started reacting in 2012. So that's why I put the end in 2012, but we can debate whether or not it's even ended. So in 2012, the EU initiated state aid investigations of Apple, Starbucks, McDonald's, Amazon, among others, and a US Senate subcommittee held hearings involving Apple, Microsoft, HP, and Caterpillar, among others. A senator at the hearings described the tax structures the multinationals were using as a complex web of interrelated foreign entities that facilitate international sales and reduce tax. So the reaction continued, and we saw multilateral efforts to get a handle on this tax planning, to combat income shifting and harmful tax competition, and those multilateral efforts include OECD BEPS, the EU Anti-Tax Avoidance Directive, and OECD BEPS 2.0, the two-pillar solution. We also saw unilateral tax policy changes, including the 2017 Tax Cuts and Jobs Act in the United States and the 2015 announcement of the closure of the double Irish. But here's something really remarkable, really remarkable. Little is known regarding the importance of tax planning strategies using hybrids. And tonight what I'm going to do is I'm going to take you behind the curtain. So there are lots of interesting research questions that we could ask. How prevalent are they? Do they facilitate profit shifting? What role does tax planning play in explaining profit shifting? We know foreign effective tax rates decreased after check the box, but we haven't been able to look at what happens to a foreign effective tax rate of a multinational that checks the box, that engages in a particular tax planning strategy. We also know little about how tax planning impacts or correlates with real economic activity, and that's a really important policy question. These questions have policy implications. So I'm very, very excited to talk to you about work in progress on tax planning on multinational behavior that I'm doing with Lyle Bowler, who is a graduate student at Duke University, and Juan Carlos Suarez Serrato, who's very well known to this crowd, who's at the Stanford Graduate School of Business. You may not find it surprising at all that I'm going to be presenting work using US tax data based on the introduction about my work. We're going to use US tax data to identify and study hybrid tax planning strategies. And I believe ours is the first systematic documentation of the prevalence and the impact of hybrid tax planning structures. And now for the disclaimer. The research is part of a joint statistical research program with the Internal Revenue Service of the United States. Any views expressed are those of the authors and not of the IRS, and the statistics in this presentation have been reviewed and cleared for disclosure by the IRS. So what I want to start with now is a little bit of a teaser. I'm going to show you a graph here. Let's look at foreign effective tax rates in the golden era. And foreign effective tax rate, what I mean here are taxes paid over pre-tax earnings and profits. That's what I'll mean by effective tax rates. And what we do is we're going to break out multinationals that are using complex tax planning structures that involve hybrid entities. So what I'm going to talk about in a few minutes are these three hybrid tax planning structures that we identify in the IRS tax data. I'll tell you about them in a minute. One is called the double Irish. Some of you will know what that is. It's not a drink, but you're going to want a drink after I go through them with you. The graph over here shows that over the period that the structures were gradually put into place, the foreign effective tax rates of our hybrid tax planners, this is the green line, fell strikingly, really strikingly. And if you look at from like 2000 on, remember these are gradually being put in place. From 2000 on, the other multinationals, maybe their foreign effective tax rates bounce around a little bit, but they're around the same as they were in 2000. And so you see that by 2016, our hybrid tax planners have half the foreign effective tax rate, 10%, than the non-hybrid hybrid tax planners. So the thing about it is the other multinationals, the black line, it's not like they weren't using hybrids. It's not that they didn't have hybrids. They simply weren't using one of the 3 tax planning strategies that we study. So it's really neat. So what are we looking at in our data, in our research with the data? What kind of tax planning structures do U.S. multinationals adopt? Do these structures enable profit shifting? Do they impact foreign effective tax rates? I think we've already seen that they have. And do they impact or do they influence R&D, some of economic outcomes, R&D, domestic and foreign employment, domestic and foreign investment? So as most talks do, I give a little preview of the results. So what kind of tax planning structures do U.S. multinationals adopt? Well, by 2016, 18% of U.S. multinationals are using hybrid structures that involve hybrids in Ireland, Netherlands, and Luxembourg. Do these structures enable profit shifting? Well, we find large increases in related party loans, foreign intangibles, and cash held abroad for our tax planners. And this is all consistent with profit shifting and deferral planning. What about foreign effective tax rates? Well, we've seen it already, but what's really neat about what I showed you was the striking reduction in foreign effective tax rates driven by our tax planners. And what about economic activity, something that we're really interested in? We find that multinationals with hybrid structures have larger increases in foreign tangible assets, in domestic investment, and in domestic payroll and R&D. So those are, again, very interesting economic questions. So in the remainder of this keynote that I'm very happy to be giving, I'm going to give you a very high-level overview of the hybrid tax planning structures. Get ready for that. I'll explain how we use IRS data to identify the tax planning structures, tell you some new facts that we found about hybrid tax planning, and then look at how hybrid tax planning structures correlate with or influence multinational activity. And then I'll sketch out a model of tax planning, R&D, and multinational production, which will help us think about the selection issue, because we do know that firms are selecting into the hybrid tax planning structures. And then I'll end with some takeaways. So let me get started. Well, I've already got started. Let me continue. Hybrid tax planning structures, the duck rabbits. So Treasury regulations that were effective January 1st, 1997, made it easier for U.S. corporations to change their entity classifications. So for example, a pass-through non-corporate classification or a corporate classification. And all of us in this room, it's nice to talk to a bunch of public finance economists, and a bunch of which work on tax. Entity classification, of course, matters for taxation. Okay? Whether or not you're a corporation or not a corporation matters for whether or not you pay the corporate tax, for instance. We call the regulations check the box to convey that it was as easy as checking a box on a tax form to change entity form. So it used to be that you had to do backflips or a bunch of somersaults or cartwheels to change form, which means that you had to have check a lot of boxes to do it. And then with check the box, it made it easier, and it was really intended for domestic firms, but it ended up facilitating foreign tax planning by making it easy to create hybrid foreign entities, duck rabbits. Remember, a hybrid entity is a corporation from the host country point of view and a pass-through from a home country point of view, or vice versa. So importantly, these regulations permitted the use of pass-through hybrid entities as disregarded entities. So what do I mean? Well, if a non-corporate entity, like a branch or a partnership, is disregarded, then the transactions that they have with their entity parent and with other disregarded entities owned by the same parent are disregarded. What does that mean? It means that those transactions are invisible to the U.S. Treasury because they're all part of one consolidated corporation. So the U.S. Treasury doesn't see the transactions, so there'll be no current U.S. tax on those transactions, okay? So tax planning structures that used hybrid entities were very good at generating stateless income. They facilitated shifting profits. They facilitate shifting profits to low-tax countries. They help you avoid or reduce taxes in host countries, and a lot of those host countries were in Europe. They allow multinationals to avoid those U.S. taxes that I talked about in the beginning on the payments of interest, royalties, and dividends between related foreign affiliates, because those payments become invisible when you check the box on one of those entities. And they also allow you to avoid foreign withholding taxes on income that's transferred to tax havens. Now, these hybrid structures are particularly helpful for intellectual property-based profit shifting. Well, as we all know, intellectual property is a major driver of multinational value. If you've got intellectual property, you should be a multinational, okay? Multinationals want to exploit their IP everywhere. They want to exploit their IP abroad. And one way for them to do this is for the parent multinational to transfer the IP abroad to a low-tax affiliate through like a cost-sharing agreement. So the affiliate that holds the IP would make a buy-in payment as part of the agreement, but determining what that buy-in payment should be, the right arm's length payment, is usually quite difficult, because typically the intangible, first of all, it's an intangible, and typically it's only partly developed at the time it's transferred, so there's a risk regarding those future earnings. So even though the U.S. does have rules in place to make sure that buy-in payments are adjusted, if the profits are too high relative to the payments, it seems possible that you can underprice that IP. This allows you to shift the income from your IP, out of the United States, and then you can use this hybrid tax planning to minimize your tax on the foreign profits that you generate from your IP. Okay, so hybrid structure is particularly helpful for IP-based profit shifting. We have something called cost sharing going on. So now it's time to talk about the 3 tax planning strategies with hybrids that we're able to identify in the IRS data. So the first one, and what I'm going to do is I'm going to give a very high-level, keynote-appropriate explanation. You are not going to be tested on this, okay? You don't even have to talk about it afterwards. You can just pretend it never happened, okay? First is the double Irish with the Dutch sandwich, which I refer to as the double Irish. So the first the multinational parent sets up an Irish holding company. The company gets the rights to use the multinational's IP abroad through a cost-sharing agreement. The holding company, okay, then will license the IP to an Irish operating company, double Irish, okay? The second Irish operating company, they're going to sell the IP outside the United States. The Irish operating company is going to pay royalties back to the Irish holding company. It's going to pay royalties from that sales revenue. So it's going to end up with little taxable income. But now here comes the Dutch sandwich. So what you do is you put a Dutch conduit in between the holding company and the operating company. Why? Because it allows you to pay instead of paying royalties directly to the Irish holding company, you pay royalties from the Irish operating company to the Dutch conduit, and then the Dutch conduit pays to the holding company. You insert this Dutch conduit. And in this way, withholding taxes are avoided on royalty transfers. It's brilliant. Royalties from Ireland to Netherlands are tax-free under the EU Interest and Royalties Directive, and Netherlands doesn't impose withholding taxes on royalty payments. Now, I see that Netherlands has made changes starting in 2021, which is pretty recent, in withholding taxes to curb tax avoidance. Now, I have to tell you something really important here, and this is really interesting. Let me go back to those royalty transfers for a second. What about those? Don't you have to pay current tax for the US, to the U.S. on those royalty payments? That was our first slide. Well, just check the box on the Irish operating company and the Dutch conduit. They become disregarded hybrid entities. They make those payments invisible to the U.S. Treasury. They're all within a consolidated company, and that way you don't have to pay the U.S. current tax on the royalties. So one more important detail. This Irish holding company, it's managed and controlled in Bermuda. So it's not subject to tax in Ireland or in Bermuda. Why? Because Ireland considers the company a non-resident because it's managed and controlled in Bermuda and doesn't tax it, and Bermuda doesn't tax corporate income. So the Irish holding company, managed and controlled in Bermuda, becomes a sink for foreign profits of the multinational, where they enjoy deferral and they're not subject to U.S. tax. And the Irish holding company, the Irish operating company, and the Dutch conduit, they're both hybrids, okay? And it looks like this, okay? Now, just so there's no misunderstanding, this is not easy. Tax planning is costly, although I have had some people in the industry tell me that this is just really nothing compared to what it can be much more complicated. Point is, it's not exotic. I don't think it's easy either. But tax planning is costly. You have to pay for advice. You have to get this thing reformed. It's also risky, and it's certainly distortionary. You certainly wouldn't do this in the absence of taxation. So it shouldn't be ignored. And we're going to take the monetary costs of setting up complex tax structures into account in our model. And it's hard to understand these structures. I know you might be suffering right now. But we have to do this if we want to study international tax and international tax policy. So the second and third tax planning structures, thankfully, they're the same, and they're called reverse hybrid mismatches. And they make use of reverse hybrids, okay, to set up this structure called a CVBV. A U.S. multinational creates two U.S.-based affiliates to act as managing partners in a Dutch closed limited partnership called a CV. Now, I'm going to now mangle the language. Communautaire Vennootschap in Dutch. The partnership is a reverse hybrid entity. It's treated as a pass-through by the Netherlands and a corporation by the U.S. The Dutch CV, over here, owns a private limited liability company called a BV. I won't even try to pronounce it, which acts as a holding company. The BV holds foreign subsidiaries. The BV holds the license for the US IP, sells it to foreign consumers, and pays royalty to the CV. By the Dutch tax law, the CV is a flow-through entity and doesn't pay corporate tax in the Netherlands. The payments from CV to BV don't pay current US tax because the BV is a hybrid. The payments from BV to CV could trigger Dutch withholding tax, but a 2005 decree by the Dutch Finance Ministry exempted US-based CV-BVs from withholding taxes. And this has also changed as of 2020, I believe. So yeah, who knew? It's complicated. Now, remember, there are three of these, okay? So now I have to take you through a third. But thankfully, the third is the same as the second. It's just you use Luxembourg entities. So what do we have here? What we have here is a lot of duck rabbits. In all of these situations, we've got these duck rabbits hopping, waddling, whatever this creature would do, going all over the place. The structures allow you to reduce tax earned on your non-U.S. income, and they all use disregarded foreign entities. They all create stateless income. And what we do is we use IRS data to measure hybrid tax planning by identifying the three structures in the data. Research on profit shifting hasn't really focused on hybrids, and the IRS data has some key advantages. So hybrids are, by definition, a disagreement in how entities are classified for tax purposes, so it's natural to use tax data to study them. And there has been existing research. It's not that nobody's looked at, check the box. A lot of research has, but they mostly use BEA or CompuStat data, and you can't identify the hybrid structures in those data sets. So we're going to use data from three tax and information forms that multinationals have to fill out. We've got parent-level information, taxes, investment, assets, payroll, and then a parent has to fill out for each of its affiliate, and there's a controlled foreign corporation. Each controlled foreign corporation has to fill out information, and that is also filed with the parent's taxes. We only get that data in even years, and we only have that data till 2016. Yes, right now, only till 2016. And it's not that just we only get the data in even years. I believe it's just, well, we only get it for even years. I won't speak for what goes on, what the Treasury Department gets. But for each CFC, we have foreign taxes, E&P, assets, and dividends, and more, balance sheet, and more than that. But what makes this research really fun, really exciting, and really new is that we have the form 8858, Yes, we have the Form 8858. It's true. And that's the form that the parent has to fill out for their foreign disregarded entities. That's the form that we get the information on hybrids for. And that gives us the country of incorporation, the date it was disregarded, and earnings and profits. So you can imagine now what we can do with this data. If you have a great co-author like Lyle Bowler that can work with it for you. So what we do is we construct a panel of multinationals and their foreign affiliates. So we match the CFC and the foreign disregarded entity data to the IRS sample of C corporations. We create a stable sample. We're going to look at how things evolve over time of CFCs with greater than 50 million assets. Why? Because there was a 2004 change in the sampling that the Statistics of Income used. So we have the stable sample. The main sample has about 3,600 multinationals, about 21,000 CFCs. Multinationals are big, okay? And 46,000 foreign disregarded entities. And what we see, finally, some more graphs, we see a rapid growth in foreign disregarded entities over this period. So prior to 1997, there were less than 50. By 2017, there were 60,000 foreign disregarded entities in our data set. So we combine this data, and the adoption of foreign disregarded entities is widespread. If you look at the dotted line here, this is the percent of multinationals, the share of multinationals, the percent of multinationals that have a foreign disregarded entity, that have checked the box, and it's approximately 80% by 2016. And these multinationals generated almost all of foreign earnings and profits. But these are just the ones that check the box. We haven't gotten to the ones that are using the hybrid tax planning strategies yet. So what we can do, if you were following, you could say to yourself, ooh, that Form 8858, that's going to be useful. That identifies the direct and ultimate tax owner of a foreign disregarded entity, and we can use these links to construct an ownership network for each CFC and its subsidiary foreign disregarded entities. And then what we can do is we can flag multinationals with ownership networks that are consistent, right? We don't know exactly if they're doing this, but they're consistent with a double Irish, consistent with a CVBV, and consistent with the Luxembourg, let's call it the Luxembourg CVBV, the other reverse hybrid mismatch, the SCS-SARL tax planning structures. So what do we learn? Finally, some new facts about hybrid tax planning. Maybe new, I mean, they're new, and I was going to say that they're kind of the only facts out there right now, using this data, of course. So the first thing we see, probably not a surprise, foreign disregarded entity, that's the FDE, profits are accruing to tax havens, especially the Netherlands and Ireland. This is adjusted E&P, so I have it ranked. We have it ranked by adjusted E&P in billions. And so this made us think that we should be looking at the double Irish and the CVBV. And as you can see, many of foreign disregarded entities are in other tax havens, Cayman Islands, Bermuda. I don't know what we think about Switzerland, but you can see that they're in other ones also. So that's the first fact that we see. Where are the foreign disregarded entity profits? Let's drill down and look at multinationals that have hybrid structures. And so let me explain this to you. So the blue is going to be multinationals that have more than one, that have adopted more than one of those three hybrid structures. The green is you've adopted the double Irish. The orange, you've adopted only the double Irish. The orange, only the CVBV. And the red, only the SCS-SARL, the Luxembourg one. Okay, and so you see that the adoption is occurring gradually over time, and it's about 16 to 18% of multinationals have adopted these hybrid structures by 2016. But by 2008, okay? It's more than, it represents 50%. Those multinationals represent 50% of foreign profits of multinationals. By 2016, we're up to more than 60%. So about 16% of multinationals were using them by 2016, and they are generating a majority of foreign profits by 2008, and over 60% by 2016. So important. Let's look at CFCs. Well, on the left, we're looking at the percentage of CFCs that contain one of the three tax planning structures, and that's really less than, it's less than 8%, but they have a very large share of foreign E&P in CFCs. There's a very large share of foreign E&P in CFCs that are connected to hybrids. Again, these are important. If I combine the information on the two slides, that reveals that CFCs that are connected to parents with hybrid tax planning structures account for 35%, more than a third, of all of the foreign earnings and profits in our sample. So how important are these guys to the US economy? Now we're looking at domestic activity of hybrid tax planners. And as you can see, multinationals with tax planning structures paid more than 20% of corporate payroll and cover more than 15% of domestic investment. So they're important to the domestic economy. And our final fact regards the industry of these hybrid tax planners, which you're probably all puzzling about already. And you're probably thinking that you know who they are, and you're going to be right. Hybrid tax planners concentrate, this would be the easy question, the softball. Hybrid tax planners concentrate in IP-heavy industries, tech and pharmaceutical. So over 40% of the firms in our sample are in manufacturing, which is representative for the US economy. But what we see is that they're disproportionately in tech and pharma. So what you see on the right, what we're doing is we're comparing manufacturing sub-industry shares of multinationals that are hybrid tax planners and those that aren't. And the hybrid tax planners, not surprisingly, are disproportionately pharmaceutical firms and tech firms. Remember, I talked about exploiting IP abroad. And this supports anecdotes of heavy use by IP-intensive industries. So those are our hybrid tax planners. So those are kind of just setting up some facts for you. What do we learn about the multinationals, their activities? What do we learn about the activities of multinationals that adopt hybrid tax planning structures? And so what we're going to do is we're going to look at key mechanisms for profit shifting. We're going to look at key tax outcomes, and we're going to look at economic outcomes. And so what I want to show you first is comparing aggregate trends of adopting multinationals and multinationals that never adopt these hybrid tax planning structures. And what I'm going to do is I'm going to start, and in fact, I'm just going to show you the key mechanisms for profit shifting and deferral, because I don't have time to show you everything, okay? So we'll look at loans between related CFCs, foreign intangible assets, cost sharing, royalties, and cash held abroad. So let me give you some time to look at this diagram that I have. And so what we have, the green line, okay, is going to look at increases in percentage terms from a baseline of 1996 for hybrid tax planners compared to other multinationals. So the green will be hybrid tax planners, and the black will be other multinationals that don't adopt one of those three structures. And so on the left first, we're looking at loans between related CFCs. Why? Because loans between related CFCs can be a sign of interest stripping strategies. This is very good for this is a profit shifting strategy. And consistent with this method of income shifting, our hybrid tax planners have a much bigger increase in loans between related CFCs than our non-hybrid tax planners. So our non-hybrid tax planners, they have about a 500% increase over this period. Okay, that's big, but the hybrid tax planners are 4 times that, 2,000%. okay? So that's loans between related CFCs, which is a mechanism for profit shifting. I talked about foreign intangible assets. And looking at foreign intangible assets will help us understand the extent to which our hybrid tax planners are exploiting their IP abroad. And we see the same thing. They greatly expand, our hybrid tax planners greatly expand from 500% to 2,000%, greatly expand foreign intangible assets. Now, some of you will think, wait a minute, how is it that you have information on the value of intangible assets? Sorry. This measure, having this measure of intangible assets is new. It turns out that parent multinationals have to report on the CFC, on the 5471 form for each CFC, a value of their intangible assets. So that's really neat, because this allows us to measure the book value of foreign intangible assets. And that's something that I don't think that we've seen very in the past. Intangible assets aren't measured typically very well on balance sheets. They typically only appear when they're transacted. So we're seeing this as a measure of declared intangible assets that were likely transferred from the parent or R&D costs that were capitalized. So very big increase there. What about cost sharing, which I already talked to you about cost sharing and the importance of that to get the IP from the parent to like a low tax affiliate abroad. So what we see on the left is compensation for services. Compensation for services is our proxy for cost sharing. It's payments to US parents for technical services. So cost sharing would be in there. And again, you see this very big increase for hybrid tax planners compared to other multinationals. We can also look at who's using a cost sharing agreement, but we can only see that starting in 2008. That's when it appears in the data. And so we see this three times more multinationals are engaged in cost sharing agreements that are hybrids. So you have 30% of hybrid tax planning. Let me say that again. 30% of hybrid tax planners have cost sharing agreements, only 10% of non-planners. Okay, so this is interesting stuff because it suggests that the decrease in foreign effective tax rates that we saw for our hybrid tax planners is really being driven by income shifting. We know that foreign tax statutory rates were going down around the world during this period. And so you might think, oh, it's because statutory rates are going down. But you can see that it really seems to be this income shifting that's really, really driving these foreign effective tax rates lower. And so what about deferral? Having moved your intangibles abroad, what we see is royalties to the parents go down. And they fall for hybrid tax planners, and they go up for the non-hybrid tax planners. Royalties here is royalties as a percentage of foreign E&P. So it seems that the royalties are getting smaller and getting held back, getting held abroad by our hybrid tax planners. So that's retaining royalty income. They're retaining royalty income. What's really neat here is, I mean, everything's neat here. What can I say? It's my talk, okay? Tax planners greatly expand cash held abroad. Why did I get so excited about that? Because in the United States, there was a lot of media attention to the amount of foreign earnings that multinationals were holding abroad. And it was a driver of a repatriation tax holiday that we had in 2005, and in 2004, sorry. You see something in 2005, and I think it's also a driver of the 2017 Tax Cuts and Jobs Act that switched the U.S. system to a kind of territorial tax system with a minimum tax. Well, what's not well known and what we're seeing is that the increase in cash held abroad is very much driven, maybe almost, very much driven by the hybrid tax planners. They're responsible for a huge percentage of that cash held abroad. And again, remember, it's not that the other guys didn't have hybrids. They're not using one of those three hybrid tax planning strategies that I took you through, that there'll be a test during dinner, okay? Just, even if you remember the names, I'll be happy. So you're probably aching right now for some serious econometrics, and that's good because you're going to get it. So the trends are super interesting, but what we want to do is obviously take into account the staggered adoption that you've been seeing of tax planning structures at the firm level, and I know there's a bunch of you saying you've got to control for differences between firms. Why aren't you doing that? We're going to do that. So we're going to estimate a standard staggered difference in difference model that's going to allow us to determine whether the timing of adoption aligns with key mechanisms for profit shifting, key tax outcomes, and domestic and foreign activity. So the staggered design is going to determine if these outcome changes are tied to firm-level adoption. We're going to have a 12-year window, 6 years before and 6 years after adoption. So here's the equation. You've got to have an equation, right? So here's an equation. Here's the estimating equation, a standard staggered differences in difference model. We include multinational fixed effects to control for time invariant heterogeneity. We're going to control for industry. We're going to control for initial levels of IP, initial levels of R&D, and the initial size of the multinational. So this will help us control for the possibility that firms might differentially select into adoption. And we're also going to estimate an alternative specification that's going to interact year fixed effects with a set of pre-treatment covariates. This is going to allow us to control for time-varying heterogeneity across industries, across foreign and domestic sales bins, and across foreign and domestic bins for intangible assets. Now, the recent literature has pointed out the potential for contamination bias from staggered adoption, so we're going to do modern methods of estimation here. So we're going to estimate the effects using an estimator suggested by Sun and Abraham, and our results are robust to using that estimator. Let me say something about identifying assumption for the staggered model, parallel trends, of course, and no anticipatory behavior. So you're going to see the pre-trends in the event study plots that I'm about to show you. They're generally insignificant. And regarding anticipation, remember we only have data for even years, so multinationals would have had to adjust their behavior 2 years in advance for our estimates to be biased. So time for the results. So the graphs show the results of estimating these staggered regressions. For 2 specifications, we have more specifications in a draft paper that we're not circulating yet, but I'll let you know when we do. You can just email me. The black are estimates that include multinational and year fixed effects, and the red include those multinational fixed effects and year by industry, year by sales, and year by IP, intellectual property, fixed group effects using the pre-adoption values. So what do we have here? Again, the loans between related CFCs and foreign intangible assets. But what we have is the log of the balance of loans between related CFCs and the log of foreign intangible assets. And you can see that the adoption of a hybrid structure is followed by an increase in loans between related CFCs and in foreign intangible assets. I'm showing you the difference in difference estimates below and the coefficients. And those, of course, summarize the average effects on the outcomes. And those are in the logs. So I'm going to do a conversion for you in the bold. So loans between related CFCs increase by almost 30%, by 29%. And loans and foreign intangible assets increase by 48%. And the p-values for both are less than 5%. So this is really interesting increase in loans between related CFCs. And you can see that that our controls really, the results don't change very much when I add those controls in. So they don't seem to be, the results don't seem to be driven by the domestic and foreign sales or size or IP. And you can also see that the pre-trends are quite good. They seem to be insignificant. So same thing here for cash held abroad. For cash held abroad, we have, again, this is in logs, so we have an average effect of about 30% increase after adoption of one of these, one of the three hybrid tax planning structures. And when you see what happens with foreign effective tax rates, they go down gradually over time. And so what we're seeing here on the right is 6 years after adoption, multinationals experience a reduction in foreign effective tax rates between 5 and 7%. That's about an 18% decline from our beginning of period foreign effective tax rate of 27%. And the average percentage point decrease is 3%. Again, you see the estimated effects are remarkably stable across the specifications. So it doesn't seem as if the results are being driven by comparisons across industries or sales or size or intellectual property. So what about real economic activity? I mean, that's really kind of was the beginning of what we were interested in doing this paper, is what's the impact of check the box on the economic activity of multinationals that use it. So what about real economic activity? Well, you see the adoption of these structures is associated with a big increase in foreign capital assets, about 19%. I don't have the logs anymore. And a 39% increase in R&D. But what do I mean by R&D here? We don't have the R&D we get off of a form that the multinational fills out if it wants to claim a tax credit for domestic research and development. So this comes off of the domestic R&D credit form. But you see there's a big increase here in the R&D credit claimed. So there seems to be these significant increases that are associated with adopting one of those three hybrid tax planning strategies. We also find a significant increase in domestic wages. That's on the left, but not for domestic investment. But for domestic investment, the picture really doesn't paint a clear result. And as in previous results, we don't estimate any significant pre-trends in any of our real outcomes. So we can translate these results into elasticities. Why? Because we're economists and we love elasticities. Just don't try to explain it to undergraduates. It's a lost cause. So we can compute tax rate elasticities as the ratios of the percentage change in each of the outcomes to a percentage change in taxes. For the percentage change in taxes, remember we see this over 6 years, so we're going to use the 6-year change. And so we have these pretty big elasticities. For foreign capital, it's 1. For domestic payroll, it's about 1.92. For domestic R&D, it's 2. And for investment, it's 0.45. Now, not finding differential trends before the adoption makes us think that, or makes us feel good that the change in economic activity is not related to differences in prior growth trends. Okay, so we feel good about that. But at the same time, it's possible that these firms are adopting these structures at the same time that other things are changing at the firm level. So maybe there's no selection based on trends, but there could be selection on who's going to benefit the most from these. So we think selection is a very interesting economic problem, and that's where we're putting our effort right now. Think about any tax policy that you might want to put in place to curb these tax structures. Well, they're going to change the cost of adoption. So it's useful to have an economic framework that helps us think through the role of selection on the gains of using the structures and on the different economic outcomes. So to think through this problem, we have, yes, developed a model. And this is very much work in progress. We're still working on it. But it's going to allow us to think about how tax planning affects the different outcomes that we've been looking at, accounting for selection. Quick overview, it's a two-country model, foreign and domestic. R&D is non-rival within the multinational. It's going to benefit any R&D that's done by the parent is going to benefit the entire multinational. The multinational is going to make three choices: how much capital to invest in each country, or foreign versus domestic, an R&D allocation that's going to affect global productivity, and then they're going to choose whether or not to engage in this hybrid tax planning. So the choice is be subject to a worldwide tax system, so domestic tax on all your earnings, or engage in tax planning by paying a firm-specific fixed cost to lower your foreign tax rate. And then we're going to derive reduced form difference in different estimates as a function of the model parameters and use these estimates for identification. That allows us to adjust the reduced form estimates to remove selection effects caused by unobserved differences in IP. So finally, we have these implied, I say preliminary, this is work in progress. We have these implied foreign tax elasticities, and you can see that selection has different effects on our economic outcomes. It's particularly big for R&D. So the elasticity I showed you a few slides ago was 2.14. Taking account selection, it goes down to 0.58. For domestic capital, from 0.45 to 0.35, and for foreign capital, it stays the same. So while foreign tax savings increases domestic R&D, most of it would have happened absent tax planning. Because those that did the hybrid tax planning, they selected it, and they did so because they probably had a lot of R&D opportunities. So that brings me to the beginning of the conclusion of the talk. So what have I done? I've taken you behind the curtain. So I've taken you behind the curtain of golden era tax planning. And what was there? I'll let you tell me. What's behind the curtain? A duck rabbit. Yes. There's a duck rabbit. Where have you been? Of course there's a duck rabbit. So the hybrid tax structures allowed firms to exploit mismatches in tax law across countries. And these hybrid tax structures were a prominent part of the international tax landscape during the golden era. Maybe still now. That's something that we can talk about. 35% of foreign profits of U.S. multinationals we're finding are booked through these structures, and hybrid tax planners are important to the domestic economy. They cover 20% of domestic corporate payroll and 15% of investment. Our hybrid tax planning strategies are tied to large increases in profit-shifting transactions and deferred income. I've said it before, I'll say it again, the relatively few companies that adopted these structures are responsible for almost all of the increase in cash held abroad during the period we study. There's an estimated 5 percentage point reduction in foreign effective tax rates, and all of the reduction from 2000 to 2016 is driven by the hybrid tax planners. Obviously, we're eager to get our hands on post-2016 data, which in 2023 we don't have. I think we'll get 2018 soon, I hope. We've seen large increases in domestic R&D, domestic payroll, foreign capital assets, and so an increase in this economic activity, but a share of the R&D was inframarginal. So in the econometrics that I showed you, our staggered difference in difference results, we didn't find evidence of important pre-trends. So that makes us feel good, but we're trying to carefully interpret our results, understanding that firms are selecting into these structures. So it's very much a work in progress. We're further developing the model to help us understand the economic features of the selection process. And now for a final word, maybe provocative, I don't know, but we've clearly found that a few specific tax planning structures are playing a very outsized role in explaining aggregate trends in multinational behavior that are associated with income shifting. And that's important for the design of the international tax system. So our results show that if you monitor tax-motivated structures set up in 3 specific countries, Ireland, the Netherlands, and Luxembourg, you may go a long way in curbing profit shifting. So thank you all for your attention. That's what I have for you tonight.